So, einen wunderschönen, I'm sorry, that was German. Yeah, hello, and I welcome you to today's special here Admiral Markets Weekly Market Outlook. Together with me in the upcoming 45 minutes. My name is Jens Klatt, and yeah, we want to have a look at what to expect in the upcoming trading week here. So the economic docket is quite packed, in fact, and we find our climax, let's call it, with the non-farm payrolls next week on Friday, then at 1:30 London time. Nevertheless, not sure whether really the economic data will drive the action of the upcoming days here, or it's probably more speculation around an escalation of a trade war. Currently, we see another sharp decline in the yuan renminbi, the Chinese currency, for example, and this is showing that the trade war somehow escalates. It's at least behind the scenes here. Between the US and the European Union, things start to calm down a little after the meeting between Donald Trump and Jean-Claude Juncker during this week. Nevertheless, there's still, I think, some potential for high volatility, probably also based on not only the trade war, but also speculation around the reaction of the ECB, which did not mention anything yesterday around its interest rate decision. But we are a little too far right now here. Let's first of all start with the risk disclaimer and then with the market outlook. So first of all, please make sure that you understand that trading with financial instruments which are offered by Admiral Markets carry a high level of risk, which is probably not suitable for all investors due to their complex nature. And before entering into any agreement or transaction, please read the terms and conditions of the service from Admiral Markets. If necessary, consult a specialist and ensure that you understand the risks involved in trading. And you should definitely, as an investor, study carefully the key information documents, the so-called KID in short, in order to understand the nature, risks, sorry, costs, potential gains and losses of margin products offered by Admiral Markets. Then there's a question, sure, why Admiral Markets? Especially in terms of the DAX, this is one of the most competitive offerings you will find out there, with a typical spread of 0.8 points during the main trading hours. Currently, in fact, the spread is 0.5 points, thanks to the 30th anniversary of the DAX that was starting from the beginning of July. And this is also something you should remember when choosing Admiral Markets. Over time, you will find such special conditions over and over again, especially when it comes to the DAX, since Admiral Markets here in Germany, for example, is considered to be the DAX specialist when it comes to CFD trading. Then there will be important changes for Forex and CFD trading here with the so-called ESMA decision, which will be implemented from next week, Monday onwards. On the website from Admiral Markets, you will where you have the chance to register for webinars, and next week there will be plenty of special webinars covering this ESMA decision. For example, also 2 webinars together with me on trading strategies and how the ESMA decision impacts them. So we will see, thanks to this, let's put this in quotation marks here, ESMA decision, that we have leverage restrictions for retail clients with a maximum of 1 to 30 for Forex majors and 1 to 20, for example, for the DAX, as an example here. There's sure possible to reclassify as a professional client, but nevertheless, there are plenty of questions probably open you might have. What does it mean if I classify as a professional client, for example? In fact, Admiral Markets has a very special offering here. One of the key things when reclassifying as a professional, for example, is that negative balance protection is not available anymore. In case of Admiral Markets, you are safe up to 50,000 British pound according to the policy from Admiral Markets, for example. So also this is one of the reasons you should carefully study the offering from Admiral. And here are the contact details. If some of what I just mentioned is of interest for you, just reach out to Admiral Markets and try to try yourself the offering from Admiral, let's put it that way. Downloading a demo account, for example, from their website. For further questions, again, contact Admiral This is me in this case, and this is our agenda for today. So let's first of all move through the agenda and then take back or go back to the several points I already mentioned at the beginning of this webinar. So the questions we want to answer here is, what are the key economic events in the coming trading week? We want to answer the question, what's the current bias in the FX, equity, and commodity markets? So, for example, I can already jump a little ahead here and say I'm currently quite skeptical for the US dollar, meaning I consider chances to be given a high that EURUSD has a good chance to push towards 115, for example, or that we go long against 111 in dollar Japanese yen. Sure, there's plenty of reasons to be skeptical, because Donald Trump, the White House, has already mentioned several times that they want to have a weaker currency, even though currently it seems as if the market will play out in favor of the US dollar. Why? We want to have a look at this here during the upcoming minutes then. And then also, sure, which trading opportunities may arise based on this outlook. And now let's jump here right to the first graphic, which is of interest for us. In fact, it's the CBOE Volatility Index. This is the, let's call it a fear barometer if you want. It's a fear index on the US equity markets. And we see that volatility collapses again. It's trading as low as shortly before we saw a huge jump in volatility, one of the biggest, if not the biggest, rise in volatility at the beginning of this year. In February, there was a huge short squeeze. Currently, market participants, especially big speculators, are shorting heavily volatility again and trading equities long. So this is a trading approach which currently is the game in town, let's call it. We've seen what will result once fear comes back and market starts to get nervous, let's say. Nevertheless, currently, in combination with the current environment, with this vacation time, for example, so holidays, it's likely that the volatility stays low. Also, you have to say, thanks to the numbers from Amazon yesterday. So Facebook dropped massively already yesterday. Over the day, you've seen it probably, that there was a wipeout of market cap of around 150 billion, if I remember those numbers correct. And also the numbers from Netflix last week already have shown that there is some fear currently, or at least there's some nervousness forming currently. Facebook and Netflix, both, as Amazon, by the way, are part of this so-called FANG basket. So that's basket contains of Facebook, Netflix, Facebook, FANG, Facebook, Amazon, Apple, Netflix, and Google. And they have a major impact, and obviously the numbers these companies then provide, this has a major impact on the markets, probably, potentially. And the thing now is that here Amazon came out with quite solid numbers after Netflix and Facebook disappointed. This is probably also able to calm the markets down a little and leave volatility low, which means that, for example, currently I think you're better off trading the long side, for example. So in my case, for example, we are here talking about US equities, but I'm mainly focused in my trading on the DAX then. I'm currently long the DAX, and that has one good reason, because I think after the comments from yesterday from Mario Draghi, and there's no escalation in those words from Draghi, but also the numbers from Amazon here, then from the US equity markets, volatility in US equities staying low. And this is a combination, this is a cocktail, which makes it likely that markets potentially drift higher. And that's exactly what we get to see currently in the DAX. Oh, by the way, I'm sorry, I just saw that was here. So there we have a EURUSD chart, but let's have a look here first of all at the DAX. And you can also see this purple line in this case, which we reconquered yesterday. So what is this purple line? That's this simple moving average 200. And usually this is a region which can be considered to be a potential buying signal once it is, in this case, broken from the upside or reconquered from the downside. And we also saw that we failed 2 or 3 times already, making it back above this level. So in combination of all what I just mentioned, from a fundamental perspective, but also from a fundamental perspective, but also from technical perspective, so chances are higher that we drift higher. And I mentioned it already in the morning towards some of my clients. I said, well, guys, I think probably it's too optimistic right now, but I could imagine that the DAX probably drifts as high as 13,000 points into the weekly close here, because currently there is no real a trigger event which could trigger more bearish action here. And this is, by the way, also the outlook for the upcoming trading week. So I definitely favor, especially now after making it back above this purple line here, even though it's a very rough indicator, but it's a good indicator. That's something we definitely have to admit. And I say, well, I think this is a good opportunity to have a trading approach which aims to somehow try to profit from the current momentum, even though momentum is a difficult word in this calm market environment. But I think that the market has a good chance to drift higher then, if it's not a strong trending market and real momentum, which we get to see, but it's like a drift higher then. And I think chances are good. Not sure if it will happen today, but probably that in the upcoming week there's a serious attempt then to make it back towards 13,000 points, and that the overall approach should be like buy the dip. So if you see a structure of higher highs and higher lows in the lower time frames, 5-minute, 15-minute time frame intraday trading, then I think pullbacks towards former highs are a good potential approach here to then go for a retest of 13,000 points, if not 13,200 points, which is here the region around those May, respectively June highs, and this big red line here on the upside. By the way, let's have a look here at the let's go here. Let's have a look here at the current environment in which we find ourselves. So what do I mean by trading a pullback? Currently, in fact, that's probably the game is over. No, not really, but we have already seen, after the market pushed higher, a pullback here, which found already some support in this region here around former highs. And as long as we trade, by the way, above this blue line here, which is the exponential moving average 50, this is a trend filter I usually use for my trading approaches on an intraday time frame for the DAX. Chances are very, very good that we're trending higher into the weekly close too, and then probably start to build a clear structure which is favoring higher highs then in the upcoming week already. And now the thing is, some of you might say, well, okay, but let's be honest. I mean, don't we depend here on the US equity markets, and how does the picture look there? Yes, and in fact, the picture looks a little extended, even though you can clearly see that after making it here above this level, which is around 25,350 to 25,400 points, after making it above that level here, I think this is also a buying signal which favors further gains in the Dow Jones in this case, which could push us as high as 25,800 points. So, and if we find this driver in US equity markets here, I think chances are good that this will also push the DAX higher. Make long things short, I'd be really careful in going anti-cyclical short right now in the DAX here. Let's therefore also recall now what Mario Draghi said yesterday. I think this is also a very good opportunity to recall this, because we want to have a look here at the USD afterwards. So what happened yesterday? Nothing happened. In fact, it was as expected that the ECB kept rates unchanged, at least through summer of 2019. That was also mentioned in a quite clear way. And there was also some comments from Mario Draghi then at the press conference where he said that significant monetary policy stimulus is still needed, for example. He also mentioned, even though not in a very aggressive way, but in a very, let's say, neutral tone, that there's a global uncertainty and that there's still threat of protectionism, which is prominent here. And this said, and after the meeting of Trump and Juncker on a Wednesday already, so one day before, where Trump secured concessions from the EU to avoid a trade war, and that European Union agreed to import, for example, more soybeans, lower industrial tariffs, or work more on liquid natural gas exports. This is mainly focusing here on the how can we call this? It's not a good relationship between the European Union and the and Russia. Nevertheless, it was something what Trump mentioned. He said, well, we support the European Union here, or Germany, for example, in terms of military and security here. Also mainly focusing here on Russia, while they make deals with Russia then in terms of, for example, gas export, respectively imports then, while we only pay and don't get anything back from the European Union here. So now the question is, nevertheless, will such a deal really play out and favor the US here when we're talking about liquid natural gas? I think that right now, chances are not that good that, or not that high, that there is not a further escalation in the near term. I think we only bought some time with this meeting between Trump and Juncker on Wednesday. I think a next escalation is probably around the corner, depending on mainly on, I think, which a European politician then probably attacks Trump in one way or the other. The next escalation was, let's call it, postponed yesterday. I said, well, if they don't agree, I really expect the ECB and Mario Draghi here to really aggressively down talking the euro, and that way counter any negative impacts trade war escalation, especially in terms of tariffs for the automobile sector, could have here for the European Union to counter these tariffs then in one way or the other. That was, this didn't happen after Trump and Juncker came along quite well, let's say. So nevertheless, it's still an option in the future, and it's still something to remember when looking, for example, here at the Euro USD. And currently, what you can see is that the euro is pushing lower. It's still trading within its range here between 115 to 118 and did not attack this level, respectively break it. I think the chances would have been quite good that we see a significant attack at this level if Draghi really put the, let's call it, bazooka on the table here and really try to down talk the euro. It did not happen, even though I think chances are quite good that rather sooner or later there will be this attack on the downside, because I think market participants still see the potential here for a trade war, an escalation between the US and the Eurozone or European Union, and to anticipate this then in a way as the Chinese did and still do, by the way, by aggressively devaluing their currency, the yuan renminbi. I think something similar should be expected here for the European currency as well in this context then. And yeah, so this means that I'm quite bearish, even though right now there's not a clear trending structure. Nevertheless, a test of the region at 115. Not sure whether it will happen next week. Probably we will build or level the path for this already today with some GDP data. We want to have a look at this here. GDP data will be published in 1 hour from now at 1:30 p.m. London. So there's plenty of chances that we will go one way or the other. In the midterm, I think it's inevitable that we will attack the region of 115. Currently, it somehow depends after this de-escalation between the US and the European Union here. It somehow depends more and more on the incoming data from the US. And if this data comes in better than expected, starting from today with the GDP data, but also then, let's have a look here at the economic calendar on the website from Admiral Markets. By the way, you can find it here via analytics and then Forex calendar, and then you can use a filter. That, as you can see here, I use a filter currently from the 27th today of July till next week, Friday, 3rd of August. Then you can also here filter, for example, the most important data. You can filter which countries you want to have a look at. And I'm focusing here on the it's G8 or yes, it's G8. And what you can see here is then GDP today, but also you have on Tuesday next week, for example, numbers around the ISM. So you can, oh, by the way, let me, here, there's the ISM on Wednesday. I thought it's the Tuesday, but the Tuesday is the 31st of July. So the numbers will be published then on the 1st of August, sure. We have also the ADP data set, for example, which is published there. And so if these data sets come in better than expected, this is also true for the non-farm payrolls and then for the non-manufacturing PMIs here on next Friday. If these numbers support a stronger USD, I think chances are higher that there will be a push towards 115. And this is also true from a yield perspective. When looking here at a chart, which, oh, by the way, let me just try to enlarge this. I'll do it that way. Yes, this is better. So this is a screenshot, as you have seen. It's the source is Twitter here, and this is a Bloomberg chart. And what does it show us? It shows in white the yield differential between 2-year European and two-year US yields right now, and in blue you see the Euro USD. And usually you have a quite strong positive correlation between those two, meaning if one goes up, the other should follow, respectively. If one goes down, the other should follow. And usually yields are a leading indicator in this case. And as you can see here, if looking at this 2-year yield differential between US and European bonds, you can see that there's a quite big gap here right now. And after the rate decision yesterday, chances are high that the blue line will follow the white line. And as you can see here, by the way, this is currently seeing a fair valuation of Euro USD at around 116. And by the way, this chart was obviously taken shortly before the push lower started yesterday. As you can see here, we traded at 116.88, and you can see it here, by the way, this is 26th, today is the 27th of July, and we already started a push lower here and currently going for 116. And I think there's a good chance that if data comes in better than expected, that the US dollar has a chance then to further strengthen against the euro and push us towards and probably below 116 into the weekly close. And if we gain momentum here in the upcoming week, chances are very good. I think that there will be, or that a test of the region around 115 is inevitable. By the way, when looking back at the DAX in this context here, we can also say weaker euro usually is positive for the DAX. It's not set in stone. Therefore, we can do the following, by the way. We can use the so-called correlation matrix. And yeah, let's take out the mini terminal here and work with the correlation matrix. You can download it, by the way, for free as a client from Admiral Markets in the so-called Supreme package. And what do we see here is we have the Euro USD and we have the DAX. So the thing is, it's not set in stone. That's what I said. If you click on this, you see in German we say schwache negative Korrelation. So there is a weak negative correlation, meaning if one goes up, the other should go down and the other way around. So this is what I mean with it's not set in stone. It's not as high the correlation as, for example, between Euro USD and GBPUSD. So this means nothing more. If one goes up or goes down, the other should follow suit. So if Euro goes down as here, well, we should expect pound sterling to go lower too. This is not set for the DAX and Euro USD, but nevertheless, you can spot a certain, in this case, negative correlation, meaning if this really happens here and we push towards 115, this also increases the chances that the DAX probably goes higher than from here and at least retests the region around 13,000 points. So yeah, that's it for the Euro USD. We already had a look here at pound sterling, and that's exactly what we want. Outlook for the pound sterling must be bearish too. That's the only way to put it. And So in fact, this has or sees probably the main driver for FX markets next week on Thursday with the BOE rate decision. It's a very, very interesting rate decision, in fact, because swap markets currently see the chances of a rate hike of the Bank of England at around 80%. So it's not a done deal yet, even though chances are very, very good that next week we'll get to see a rate hike of 25 basis points. So now the question you might have is, okay, well, especially when looking at the candle yesterday here, this red candle lower, and the pound sterling obviously not seeing any big signs of push higher. Well, probably market participants probably are just too late here to realize that. So it's a great chance to now go long pound sterling, right, against the US dollar. No, that's definitely not the case. And then now I want to tell you why. I'm not very convinced that pound sterling will see serious strength next week. So I could imagine not only based on my bearish outlook for euro against the US dollar and the negative, the positive correlation between euro and pound sterling, not only because of that pound sterling has a good chance to push towards and below 130, but it's also due to the fact that the current political situation and the Brexit negotiations, which are to some extent stuck right now, and we don't move really forward here, that that this uncertainty, political uncertainty, favors pound sterling weakness, and this is due to the fact that if a rate decision, if a rate hike in this case from the Bank of England is a done deal, what market participants want to see is what can we expect after this rate hike. So will there be another rate hike, another 25 basis points then within the next months here at the or into the end of 2018, or won't there be a rate hike? In fact, the current situation is quite difficult, because I have to say, after the latest employment data, for example, which came in here last week around the pound sterling, I think chances are somehow not chances, but the outlook, the economic outlook for the United Kingdom is not as strong as it justifies a really aggressive rate hike cycle from the Bank of England. So this said, it increases the chances, I think, that the Bank of England will hike rates, but it will be a quite dovish hike, meaning they hike rates probably once, probably to work in some, let's say, let's call it a buffer here, just in case that the UK economy here falls apart. Well, this won't really happen, but nevertheless weakens in the next months, then significantly weakens. Also based on the outlook that probably the Brexit negotiations are capable of suing enough uncertainty around the economic outlook for the British Empire in general. And with this in mind, a dovish hike then could mean that even if the Bank of England hikes, that here, with the outlook of no further rate hikes in the future, that pound sterling could see a push significantly lower. Again, driven mainly by also the euro, which could push lower, respectively, to be expected US dollar strength, but also the uncertainty around the Brexit negotiations in general. By the way, let's have a look back at the US dollar once again here. I've prepared something around the commitment of traders report. This is how the big speculators are positioned currently. And so what I consider to be really interesting in this context is the following. If you carefully watch at this green line, it shows that there is a long position right now on the big speculators. That means that the big speculators currently is positioned long. Nevertheless, as you can see here, if you compare, for example, around the time of the Trump election in November 2016, it's a quite moderate long position here. And with this in mind, there's still some room on the upside. And the interesting thing now is, from a technical perspective then, by the way, if you carefully watch this region around 95 to 95.30, it's a very strong resistance on the upside. And if US dollar index pushes above that level, this could trigger some aggressive selling in the US dollar on a broad front, because market participants, big speculators, are moderately long positioned. So When now taking into account that 58% of this basket, by the way, let me just do the following. 1 second, please. USD index. Let's use a clearer picture of that. Here, you can Google US dollar index, and then you can see here the weight of each currency which is listed here within that basket. You can see 58% euro, obviously, but pound sterling also 12%. So euro and pound sterling together add up to 70% of the overall weight in this basket. So now the thing is, if you picture such a bullish outlook for the US dollar based on a potential breakout here on the upside, which is, by the way, then leveling the way up to, I think, 97.50 to 98. This is mainly due to the fact that here this consolidation area between 93 to 95, 95.30, you can duplicate this range and then just put it at the level of the breakout, and then you end up around 97.50 to 98 on the upside here. And so with this in mind, also here, there's a good chance then that with such a bullish breakout in the US dollar index in this case, that this is pushing pound sterling lower. So that could be a combination in both cases, in case of the euro, but also in case of the pound sterling, that there is euro weakness based on the outlook that the ECB will most likely hike rates from the second half of 2019 onwards, but definitely depending on how the overall economic outlook, also when facing fears around the trade war with the US and all this, that from there on we should expect rate hikes to happen here. So which is very, very dovish compared, for example, to the US monetary policy. And with the Brexit negotiations being stuck right now and the overall skepticism, if there is some significant strength and momentum in the UK economy, there's also some doubts that here pound sterling is a buy. It's more a sell, let's put it that way, while the US dollar seems to face a next wave of strength here. So you're, in case of going short pound sterling USD or euro USD, you're selling weak currencies and you're buying the strong one, which is exactly what you should look for when trading currencies, by the way. So so with this in mind, I think the overall picture for pound sterling, but also for the euro is not that positive. And this may surprise some of you looking at this chart here, and all the time here over the last minutes facing this potential bullish divergence, which is showing that the market is making lower lows, while the RSI is obviously not confirming these lows again. Nevertheless, it's only an indication, and I think we could start to see the picture brighten up here once pound sterling is going above 133.50, 134 around. So, and not only going above that, but closing above that level. And currently, when putting all these components I just mentioned and listed here, we put all this together, I think chances are not that high that this will happen next week. So I don't see enough hawkishness in the statement from the Bank of England after their hike next week on Thursday that such a push above 33.50 to 34 will really happen with a close above that level. But instead, I expect pound sterling to push lower from here. And let's have a look now at the dollar Japanese yen. I think also very, very interesting currency pair right now. If you really zoom out of the chart, what you can clearly spot is that after this break of this trend line here, which is a quite significant one. So usually I'm not a big fan of such trend lines. I'm more kind of a guy who's looking for horizontal lines in this case. So diagonal lines is something I'm a little skeptical about. Nevertheless, the more points you connect with each other here, the more significant such a trend line becomes. And in this case, we're going back to the year of 2015 and seeing the market failing over and over again, and now making it above that level. And after making it above that level, and now with volatility pushing lower, while trade war fears, even though they're still around the corner, nevertheless, the situation calms down a little. This is favoring potentially risk-on market environment, currently at least. And with having such a market environment, which is risk-on, the Japanese yen is a clear sell usually, because what you usually do is you finance carry trades with a cheap currency like Japanese yen or the Swiss franc, for example. And in this context here, with the bullish outlook for the US dollar, then I think dollar Japanese yen finds also from a purely technical perspective in the region here around 111, and this trend line, the former highs here, which acted as a strong resistance on the upside and is now acting as a strong support region around 111. I think that chances are very good that we're looking, or that we could push higher from here, and probably see another attempt to attack 113, probably 113.50 to 114, if this strength in US dollar really plays out. The only question you might have is, do you really want to go long here right now, or is it probably a better idea to still wait? And I'd go for the second option here. I'd still wait, because I want to see, now we are down on the 1 hour chart here, I want to see the structure falling highs and falling lows in the hourly chart to be broken, which will happen once we push back above 111.50. So we are short of this level, so it's not such a long way to go. Nevertheless, we haven't made it back above that level yet, and that's one of the reasons why 111.50 push back above that level should be waited for. Also, by the way, something which could happen within the next hours of trading then into the weekly close, that has something to do with the fact that, again, GDP data is around the corner. Now we have 45 minutes to go from here. And with this in mind, let's have a final look then probably at this data set. And by the way, what I already want to do is, because we also want to focus here on precious metals a little and have a look at gold once again. But before we look for gold, which could also be affected by the numbers being published here, just to give you an idea of what to expect right now, respectively, when did we see such a number before? And this is showing how, yeah, if the numbers really come out that way, I think they really favor strength in the US dollar. On the other hand, chances of being disappointed are also given. And so the data set itself is probably interesting to really watch then. So what we expect, therefore, let's scroll lower a little. So it's tradingeconomics.com. What we expect is a consensus here of 4.1% quarter on quarter for the first estimate in this case here. And so the interesting thing is that the previous numbers were 2%. So it's obviously, let's call it double up if you want, but also it would be the highest print since 2014, last time when we came in above 4% here. And so now things are really getting interesting, because if numbers really beat the expectations here, this is showing some serious momentum in the US economy then in this context. Sure, you can easily find ways to counter this argumentation when looking at the employment situation, where are jobs created and everything, etc. Nevertheless, it would favor further US dollar strength if numbers really beat expectations. On the other hand, if numbers disappoint, still come in above 2%, I still consider it to be a solid sign of economic growth here. And this, even though the US dollar is probably not likely to attack then, in case of the US dollar index future, then the attack the region around 95 to 95.30, still chances are good and given that the US dollar can take on some momentum, and that probably EURGBP, for example, sees a test of the region around 116 into the weekly close. Finally, let's have a look again here at gold. Situation at gold still is not very positive for bulls, at least at first glance. When looking at the gold chart, the picture does not look very promising. So we are still caught here within this channel, downward channel. And so far, it doesn't seem as if gold is currently bottoming out. But again, with the weakness from yesterday and also today, we are more likely to see another test of the region around 1,200 USD per ounce. The key level within the next trading week, I think, will be around 1,235 USD per ounce. If we make it above that level, it does not favor further strength. Still, we're we would trade within this channel here, the down channel. Nevertheless, I think it could be a first sign of further strength to be expected. And now let's come back to the commitment of traders report. The last time we've seen such, let's call it moderate long position in gold futures was here in July 2017. And you can see what happened afterwards. And at the beginning of September, we were trading more than 10% higher here trading around this region, which is currently to be considered the key make or break level for mid to long-term outlook for gold. If we make it above 1,360 to 365, this is a clear bullish signal, by the way, and also favors, by the way, in economic downturn and then the US potentially drifting down into a recession, by the way. But nevertheless, the thing is, and that's what I want to focus on here, you should remember this level around 1,235 USD here on the upside. If we make it above that level, this could be a clear sign that there's further strength to be expected, and that a similar run as last year in July here will take place then. And therefore, again, let's have a look at the commitment of traders report. Therefore, so we're looking at this level here. This is July last year, and have a look here at this. And therefore, by the way, let me do it that way. 1 sec, please. So we focus here on this, and then look at the net long position of the large speculators we focus on here. And currently, we're trading near to this region, and again, we see a quite diminished long position in that long position. By the way, we have seen this several times before too here. So this is another point we could mention here. Also here, for example. Nevertheless, it could take it some time since we take off. Nevertheless, if we take off, it's sometimes a very sharp push higher. And again, so from here, as long as we trade above 1,200 USD per ounce, I think chances are good that gold probably will take off from here. Now, the interesting thing about this is, if I'm drawing a bullish picture for the US dollar, how can I be bullish for gold too? And this is the problem right now. So this is the question I have to ask myself respectfully. I have to answer myself here, because this picture I'm drawing here for gold does not fit the overall bullish outlook for the US dollar, even though I could imagine to formulate potentially something I'd call a spread trading idea. So going gold long, for example, but also going long US dollar Japanese yen, because again, such a negative correlation between the US dollar and gold is not set in stone, and there's still a chance that gold could push higher while the US dollar stabilizes or pushes higher too, by the way. And this is something which is yeah, to be taken into account here. Nevertheless, something to remember. So it's in fact a quite interesting picture. If you put a gun to my head right now and ask, okay, tell me gold or US dollar, currently I'd go for the US dollar and the breakout higher. Nevertheless, I have gold in mind here, and could imagine taking gold taking off from here, similar as it did last year. And especially if a trade war escalates in one way or the other. This is usually a sign for risk aversion, which is usually favoring more gains in gold than to be expected. And that's it from my end for this week. So I hope you enjoyed this webinar. I wish you all the best. Happy trading. Watch your stops. If you have any questions, please feel free to shoot them over, send me an email, or send an email to Admiral Markets. They will forward it to me. I will answer it. There are plenty of ways to communicate with each other. And yeah, so far that's from my end. So have a nice weekend. Enjoy yourself. Take care. Talk to you again next week on yeah, in fact Monday with the real-time trading ideas already. So let us just go back here to the website from Admiral. So if you just enjoyed what you heard here, so I'll be here on Monday then, real-time daily trading ideas, but also next Wednesday plus next Friday in 2 ways, by the way. So it will also be the weekly market outlook then here next week again. So yes, please feel free to join the webinar. All the best from my end. Have a nice weekend. Talk to you soon. See you and bye-bye.